They're not going to build anything. They'll stop all building, all construction. This happened again in 2008, 9, and 10.
Let's say I've got a house and I paid $500,000 for it, and it's worth $400,000. And so I'm underwater.
You won't believe what Peter Schiff and Grant Cardone just said about the housing market. It's almost the opposite of what I would have expected Peter Schiff to say. Let's get into this a 5-minute or so clip. This is from an interview with Sachs Realty and Peter Schiff. Looks like they went to his house. Hey, I've been to his house too. Peter Schiff's a great guy. Don't always agree with everything he says, but this perspective was really interesting. So let's add some commentary to it. It's only about 5 minutes long. Keep in mind, today is Black Friday. So we've got the Black Friday sale going on. We reduced prices, hashtag deflation. So we've got the best deal guaranteed you can get on the courses going forward. You got any questions? You're an existing member, want to bundle up. We're going to take care of you with the new content we got coming out. So just email us at staff@meetkevin.com. A lot of people are also asking for the HouseHack financial advice videos, the non-personal videos, and they just want the library. They don't even want their own financial advice. They want to see me give financial advice to other people, like licensed financial advice to other people. Just email us if you're interested in that. Staff@meetkevin.com or anything else at meetkevin.com will help you out. All right, let's listen to this. This is wild. Here we go.
What does that mean for the market right now, the housing market?
It's a little bit different than it was back in '08. So today, since the most valuable asset that the homeowner has, really more than his home, is his mortgage, a lot of people are going to want to stay in those homes. Even if the home price goes down, their mortgage is so low that it still might be cheaper. Let's say I've got a house and I paid $500,000 for it, and it's worth $400,000. And so I'm underwater. Back in '08, the borrower would say, well, I'm wasting my money. Why am I going to pay this mortgage? I mean, I have negative equity. I'm just giving money to the bank. I'll go rent something, or maybe, I'll buy something else at a lower price. But even if you bought something at a lower price, if the mortgage was 8% and not 3%, even if I got a better deal on a home, my monthly payment is going to be higher. And the same thing with rent. A lot of people might be living in a home that they...
I just want to clarify what Peter's saying here. He's saying what's different today from 2008 is that if you leave, your payment goes up. So this sort of clickbait real estate crash that everybody keeps talking about on YouTube has really been a crash of housing volume so far. Now, don't get me wrong, we've covered the housing crash in depth, and in every single video we're like, at max, we've seen 10 to 15%, maybe 20% in some COVID boom markets like Austin or Boise. But then we saw some recovery in 2023. Then it started softening again in October and September of 2023. But so far, no big 2008. Instead, the big year-over-year negative numbers that we're seeing are volumes down. People aren't selling as much as they used to. And people aren't buying as much as they used to. So yeah, you have a volume crash, which affects service providers in real estate. But this is such an interesting argument Peter talks about because it's the lock-in argument, which is literally the opposite of what you had in 2008. Now, Peter said the words, this is different. So that obviously triggers a lot of people to say, oh, he said this time's different. That must mean it's not. But it's not different this time. It's the opposite. In 2008, and I find this so interesting, in 2008, people were paid to get out of their home. So they're underwater, and banks came to them and said, look, rather than go through foreclosure, let's do a short sale. Here, take 10 grand of moving money and 10 grand just as a thank you for doing a short sale, basically making us lose money on the loan, but thank you for getting out. We'll pay you 20 grand, basically just to get out. And then you can go get a lower payment somewhere else. And you get rid of that negative equity that you had. Like, why would people not take that deal? So you get a surge of housing inventory that really collapses home values up to 45%. In some commercial places, you saw commercial values fall over 50%. And when I say commercial in this case, I mean commercial residential. Commercial office today is a disaster. Totally different story. But that's interesting because it's the opposite of today, where if you move, your payment goes up, either via higher interest rate or higher rent payment. You're not negative equity in most cases. And yeah, even though there are people who have foreclosures or are going through foreclosures, they're a drop in the bucket relative to the percentage of loans outstanding or relative to even historical levels of foreclosures. I mean, quite frankly, we could just look at 30 days or more past due on the St. Louis Fred website here, which takes us all the way back to 2013. This isn't even showing you 2008. I wish it would go back further. But even just going back over the last 10 years, we're basically at the bottom. And this is 30 days past due, so it'd be a pretty early indicator of foreclosure or housing payment stress. We're at 1.48%. Now, sure, some people like to say, oh, well, if you look at FHA, it's higher, or VA, it's higher. Sure, but those are also loans with a substantially higher debt-to-income ratio, and they're always higher, and they're always part of the same curve. So this is a fascinating argument by Peter Schiff, because he's really arguing this is not different. This is the opposite housing market that we're in right now. Very odd. But this is very similar to what Grant Cardone just said. Listen to what Grant Cardone just said in a video with, well, the old buddies.
So how are you using this as an opportunity to make moves?
We're buying every piece of real estate that we can buy that cash flows right now with no debt.
So how have you positioned your portfolio to weather a potential storm if prices continue to drop or interest rates continue to go higher? Like for your existing loans, let's just say.
Yeah.
Are those...
We have 39 loans.
Sure.
We have 5 of those loans. 32 of the loans have 10-year mortgages. We have 5 loans that have adjustables through 20, what are we in, 23? Through 25 2-year extensions. Those will have to be fixed. It's 15% of the entire portfolio. So, I mean, I have it charted out exactly what I'll have to fund to fix all that. It will. There's an old adage, Nathan Rothschild, I think, said, when there's blood in the street, buy, comma, even when it's your own blood. So we expect to, we have 12,000 apartments right now. We expect to double that portfolio in this cycle, maybe in the next 6 months.
Do you worry, though, about interest rates resetting at a higher amount while at the same time rents are falling? Or you believe that rents will continue to go even higher?
I think rents will flatten. I think rents flatten for the next 2 years. 24, 25, you'll have flat rents. And then in 26, because they're not going to build anything, they'll stop all building, all construction. This happened again in 2008, 9, and 10. We're 4 million homes short in America today. We're probably another 40 million homes that nobody wants because they're old homes. They're your mom's and grandma's house. Nobody wants to move into them. And in 26, 27, rents will explode in this country.
Holy smokes! Cardone's just buying everything again. And he thinks rents will explode in a couple years. Does that mean there's a 2-year window to go pick up real estate? Let's keep going.
Paid $400,000 for, that's worth $300,000 or maybe even $200,000, but their mortgage is so low that if they just walked away and they rented a property, their rent would be higher.
Here, Peter Schiff is saying, even if you went negative on the value of your home, if you had that low mortgage rate, you'd still end up having a lower payment by staying in a negative equity home today. Again, reiterating the opposite of last time. Fascinating.
So it's like, doesn't matter that I'm giving money to the bank. I got to live somewhere. I'd rather give it to the bank than a landlord. So that's an incentive for people to stay in their homes and continue to make payments, even if they have negative equity. So that's going to keep some of the supply off the market, maybe a lot of the supply.
I have never heard that explained that way. That's brilliant. What you just said is
Yes.
what's happening.
And
We don't think about that often, but when we look at the actual data, that's what we're seeing. I mean, on a daily basis, I say people get way more views than I do, which is fine. I mean, you know, if they want to blatantly lie to people, that's okay. I'm going to do my best just to talk about reality. But I think there's this desire to say, oh, you know, housing is crashing because it's going to get a lot of views. But the reality is, every time we analyze it, we're like, well, you know, it's not going to be like 2008. Yeah, we're having softness. And yeah, there's a fear that what if housing inventory bumps in spring? Well, I think that's a real concern, is what if housing inventory bumps in the spring? Now we have more houses with less buyers. Could housing prices fall? Yes, but how much before you start inducing more buyers? Because as soon as prices start falling, more buyers come out of the woodworks. Because a lot of people are like, okay, when's the bottom? When should I go buying? So it's really interesting. Let's keep going with shifts here.
it also means that people might rent out their house rather than just selling it.
Right.
If it, you know, because if you sell it, you lose the mortgage. right? It goes with the house. And these mortgages are not assumable. So the new buyer can't get it, but the renter can benefit from your mortgage because you keep paying the mortgage and he gives you rent.
So we have that scenario, right? And so they keep their mortgages, the ones that can continue to pay, even though their home prices decline, they will be less inclined to sell because obvious reasons. Even if we had a massive home price crash with the mortgage rates, unless they were low too, they would be paying more money for less house.
Yeah, I mean, if the market crashes and then the Fed is able to slash rates and mortgage rates come way down again, that would change the dynamic.
But that also affects their if they have any equity left over.
Yeah.
But what happens to the people and the home prices of the ones that no matter what their interest rate, they bought it 3.5%, but they still can't sustain the higher prices.
For some reason, Sachs Realty, by the way, is really interested in asking questions around the idea of, it's going to crash, right? It's going to crash, right? And here Peter's basically saying, yeah, like, of course there are always going to be people with foreclosures. We already pulled up the stats, so just remember that chart we saw.
There can be people, even with a low mortgage, that can't make the payment, right? Because they lost their job, or they have a job, but it doesn't, they're not earning as much. And so there's still going to be people walking away. There's still going to be foreclosures.
Now Peter Schiff is talking about housing prices coming down relative to gold. Now this is a fascinating idea because I don't disagree with this. I'm a big fan, and so far actually I agree with everything Peter Schiff is saying. I think that having your money exposed to the dollar is a terrible idea. The dollar will almost always lose value in purchasing power. You got to get out of the fiat currencies. You could do that by owning assets, or by investing in commodities, theoretically, like gold. I personally prefer assets, which gold is an asset too, but I personally prefer stocks and real estate. So there is a chart though for real estate about pricing real estate to gold, and you can see here how relative to gold, our real estate values today are a fraction of what they were in the early and mid 2000s. What a weird, like almost feels like perverted chart to look at. And then of course, as gold prices rose in the recession and housing prices came down, housing prices relative to gold and relative to fiat came down, you saw this decline in housing values. But when we look at where we are now relative to where we've been compared to gold, real estate, I mean, looking at this chart, is almost cheap today. That's wild. I mean, off of the bottom, relative to gold, we were at a low of about 139 here. We're about double. Call it 140. We're at about 280 right now, right? So we've gone up about double from 2011, that bottom, to today, relative to gold. However, we are still 1/3 of where we were in the dot-com mid-2000s era, relative to gold. Now, I'm not the biggest fan of using a chart like this, so I think we have to kind of take it for what it's worth because housing feels ridiculously expensive right now. But if you do listen to the Schiff argument and compare it to gold, it doesn't feel that overvalued. But all of us, I mean, like, it's kind of frustrating looking at this chart because it's like, but it's so unaffordable to buy a home right now. How could it not be overvalued?
So a house that's $200,000 is 1,000 ounces of gold, right? Now, you might be able, that house might go up from 200,000 to 300,000. But it might go from 1,000 ounces of gold to 500 ounces of gold, right? So it doesn't matter that the price has gone up in dollars. It's half off in real money. And that gives you a better measure of what's happening.
So do you think people right now, if they're safe or they can afford the payment, that it is wise for them to buy a house and that the next several years that we will see prices rise?
Well, I was telling people, before rates went up, I said, look, I mean, buying a house is an okay deal if you get a 30-year mortgage in the threes, because that's a great deal, to get.
That's interesting. Peter saying, hey, look, if you could get a 30-year mortgage with an interest rate around the threes, go for it, because you're basically shorting the dollar. you're owning an asset, and that asset goes up with inflation, maybe slightly more than inflation, but your debt stays the same. So the value goes up, your debt stays the same, which makes it easier to pay off in time. So owning real estate is awesome, especially if you can lock in long-term debt. Let's keep going.
That cheap money. So even if you overpay for your house, it's okay because of how cheap the loan was. But
then.
now that the rates are higher, it's not as, clear cut. You're paying 8% now instead of 3%, right? But I still think that there's going to be a lot of inflation to wipe out the mortgage. So it might depend on
Time.
Well, where the house is, what you're paying for it, the neighborhood. I like to look at, the construction costs or replacement costs. I mean, if you can buy a house for less than it would cost to build it and the land is free, then it's like, okay, it makes sense because, I got the land for free and I bought a house for less than it would cost me to build it. Real estate could be an investment if you buy it, and it cash flows and you have tenants and, it works. The math works where you get a good return on your money, right? You have positive cash flow. And you can scale that up, and it's an investment. But just buying a home that you live in, it's not an investment because your property is depreciating over time.
Wow, this is some really interesting insight from Peter Schiff. I mean, first of all, if you trade a house that you live in like a rental property, it could be an investment. The problem is most people end up over improving the place they live in, and then they spend money in a way that they shouldn't. We already know that. But as far as location, yeah, Peter's also right. Like the value of land could go down and the value of real estate could go down if you buy in basically a bad area or an area that's going bankrupt or a town that's going bankrupt or whatever, which is actually very similar to what Grant Cardone says as well. But Peter's primary argument here that's worth reacting to and highlighting is that Peter Schiff isn't actually suggesting that there would be a very large housing crash today, because we're just not seeing distressed sellers. Yes, volumes are down. Yeah, there are foreclosures, but there are always foreclosures. And yes, maybe inventory will go up, but he's not actually seeing a big, oh no, housing market crash on the horizon. Again, we've seen fluctuation in prices, especially some COVID markets. Again, I can make it very clear for you. We can look at charts. It's so simple to see. Housing prices came down from peak about 20% in a city like Austin, bounced back about 10. Now they're softening again a little bit. This is just the volatility of post-COVID adjusting. Are these really housing crashes? Or are they potentially just an opportunity to say, hey, you know what? You're going to look for a really good deal in your neighborhood, negotiate on it, buy it, and then once we get through the disaster that we've been facing of all of this political and economic and Federal Reserve and inflation uncertainty, then we've got a property that hopefully can just be back on the real estate ride of rents stabilizing and slowly trending back up and creating value for people who buy them or people who live in them. Anyway, my thoughts. Let me know what you think about what Peter Schiff said. Link down below, and check out my programs on building your wealth at meetkevin.com.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.